We're seeing some really fascinating moves in the market right now. Traditional safe havens like gold and silver, they're significantly outpacing stocks. So, in this explainer, we're going to break down what those signals mean and look at the specific tactics both investors and traders are using to navigate this exact environment. But first, we've got to cover the important legal stuff. This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. Links and resources are available in the description below. Okay, let's get right to the big picture here. The S&P 500 is up a very solid 10% year to date. I mean, that's a great return by any standard, right? But that's not the whole story. Just look at precious metals. Gold is up 18%, and silver is just crushing it, leading the whole pack at 22%. Now, when you see physical assets like these outpacing the broader stock market by this much, well, that's a huge signal that investors are getting a little nervous and looking for safety. So, to really unpack what all this means for you, we're going to walk through 4 key areas. First, we'll decode the signals these metals are sending us. Then, we'll get into how to build a portfolio that can handle this kind of environment. After that, we're going to zoom way in on specific tactics for active traders. And finally, we'll step back and cover the core principles that really tie everything together for long-term success. So let's start with section 1. What are these metals trying to tell us? Because their powerful performance isn't just about the price tag. It's about what that movement reveals about the entire economy. Here's the key takeaway, really. A rising price for gold and silver is often a big, flashing warning sign that the US dollar is losing some of its buying power. And when that happens, investors don't want to just sit on cash. They start looking for tangible things to protect their wealth. Just think about it this way. If the value of the cash in your bank is slowly getting eaten away by inflation, you'd much rather own something real, like commodities, stocks, or even real estate. It's an environment that tends to really reward people who own assets. Okay, so we've identified the signal. Now the big question is, how do we turn that insight into an actual strategy? Let's jump to section 2 and talk about building a resilient portfolio. This table lays out a pretty modern, diversified approach. I like to think of it like building a sports team. First, you need your offense for growth. That's your broad market ETFs like SPY or VOO. Then you absolutely need your defense to protect against things like inflation and a weaker dollar, which is exactly where commodities like gold and silver come in. And third, you can bring in a specialist for consistent cash flow. That's where covered call ETFs like JEPQ and Devo come into play, since they're specifically designed for income. Now, you might be wondering, what in the world is an equity premium income ETF? Let's break it down really simply. Imagine you own a big basket of stocks, like all the companies in the NASDAQ 100. An ETF like JEPQ basically rents out the potential upside of those stocks by selling options, specifically something called covered calls. In exchange for putting a cap on some of the potential gains, it collects a regular rent payment, and then it passes that payment on to you as a high monthly dividend. It's a clever strategy for turning a growth-focused index into an income machine. If you find this overview helpful, please consider subscribing to the channel for more concise market updates. Now, let's switch gears from long-term strategy to the super fast-paced world of active trading. Section 3 is all about tactics for navigating the market, especially during that chaotic first 30 minutes of the trading day. This is the million-dollar question for so many traders, isn't it? The market open is just packed with volatility and all these psychological traps that are basically designed to shake you out of good positions. So, how do you navigate that mess without getting caught? Well, a lot of institutional traders use a playbook that's designed to trick, trap, and frustrate retail traders. And these are 2 classic moves. First, you have the dip and rip. A stock opens, it drops just enough to hit everyone's stop losses and scare out impatient sellers, and then it reverses and rallies higher. The second is the complete opposite, the rip and dip. It skyrockets at the open, baiting in all the FOMO chasers, only to reverse and fall, leaving them holding the bag. And here's why getting caught in those traps is so painful, especially if you're trading options. It all comes down to something called theta, or time decay. The best way to think of an option is like a melting ice cube. Every single second that passes, it loses a tiny bit of its value, even if the stock price doesn't move at all. So if you buy a call option during that initial dip, your ice cube starts melting immediately. Even if the stock rallies all the way back to where you bought it, your option is now worth less than what you paid. That's how you can be right on the direction and still lose money. So frustrating. So, what's the antidote to all this chaos? It's patience and having a process. This simple 3-step approach can save you a world of hurt. First, just watch. For the first 30 minutes, just observe the price action and let the market show you its hand. Second, identify where the key support levels are forming. And third, and this is the most important part, wait for the trend to actually confirm itself before you jump in. Don't predict, react. And for those of you who are just starting out, you do not need a cluttered screen with a million indicators. Just focus on these essentials. The 13, 48, and 200 exponential moving averages help you see the short, medium, and long-term trend. And the VWAP, or volume-weighted average price, is so important because it shows you the average price where the big money's been trading all day. It kind of acts like a magnet for the price. Master these 4 before you even think about adding anything else. All right, finally, let's zoom back out for our last section. Because whether you're a long-term investor or a day trader, success is ultimately built on a foundation of core principles and just having the right mindset. This is such a powerful mindset shift. You are the CEO of your portfolio. What does that mean? It means you are in charge of everything. You set the rules, like always using a stop loss to protect your money. You celebrate the wins, sure, but more importantly, you take complete ownership of the losses and the invaluable lessons they teach. Everyone loves to talk about massive gains, but professional investors and traders, they focus on one thing above all else: protecting their capital. Your number one job is not to lose money. The reward is a byproduct of excellent risk management, not the other way around. If you protect your capital, you'll always be in the game to fight another day. This might just be the most important principle of all. Nobody wins every single time. Your losses aren't failures. They're the tuition you pay for your education in the market. Every single setback contains a critical lesson. The key is to learn from it, refine your process, and use that knowledge to build an even stronger foundation for success. So as we wrap this up, I'll just leave you with this one question to think about. Looking at everything we've covered, what's one small adjustment you can make to your own process starting today? Thanks for watching this video overview on 15 Minute Investor.